I feel like I have seared in my brain this image of Dan's basement.
Yeah.
And they make some joke that like the bathroom had been redone since he was there. So even this like dungeon that doesn't look particularly appealing was better than the shape it was in when Alex was living there.
Welcome back to VBSR. Sarah, it's been a pretty intense but amazing week at Accel, which
Very
is
busy.
Great. Yeah,
Yes.
lots of cool things happening.
Yeah.
Gives us a lot to talk about.
Absolutely.
Before we dive into the Accel-related things, because we could spend all hour talking about Accel, there was an interesting presentation from Andrej Karpathy, who we've talked about already,
Yes.
at the Y Combinator AI Startup School.
Yeah.
And he put forth a really interesting framework for just thinking about the evolution of software. Mm-hmm. And it's something that's been kind of rattling around in my brain around our partnership as a really helpful understanding for where we are in the history of computation and, potentially what's to come.
Mm-hmm. I loved it. I loved it for a lot of reasons. I think he put, as you're saying, a lot of frameworks to a lot of the changes in the industry and sort of paradigm shifts in terms of how software is generated, how we engage with it. And those frameworks themselves were really helpful. I also thought he did a great job of providing analogies that were very approachable.
Yeah.
When you're talking about, Rain Man or, 50 First Dates and saying use these to sort of conceptualize what the LLMs can and cannot do.
Yeah.
I just thought he had a really lovely way of making some of these like ambiguous concepts very tractable, so that you can, get grounded in what they can and can't do, and then use that as a basis for talking about it.
And for anyone listening who hasn't spent time with this talk, maybe it's worth covering just very simply his framework. He started by talking about Software 1.0, which is kind of the world of software that most of us grew up in over the last decade and a half, which is someone delivers an instruction set to a computer. I think he described it as, it's the standard collection of for loops or if-else statements, and you feed it those instructions and it's able to spit something back to you. Mm-hmm. And so it's very tangible, it's very deterministic. Software 2.0 nicely coincided, I think, with his time at Tesla, which is how do you not feed a system just a set of code, but also a set of data? Mm-hmm. And how does that data then inform what that system is able to do or not do? So in the case of Tesla, as an example, taking all of the images of all of the cars that are out there in the world as they interact with road signs or traffic markers or humans, how do you interpret those images and make sense of them? And what is the implied decision as a result of it? So, hey, you run into a stop sign, the car is meant to stop. And Software 3.0, which is sort of the epoch that we are in now, is the advent of these foundation models, these LLMs, that we can now instruct, not by code or data, but just by natural language. Mm-hmm. And it connected to something we talked about earlier, of just how broadly consumable AI has become when you reduce the interface of technology down to a prompt and down to just natural language.
Right.
It allows anyone to interact with this technology.
Maybe just to call out, I think, two other interesting things from that talk. So one was, as he was talking about those sort of three eras, he was describing, honestly, a lot of the sort of surrounding infrastructure that needs to exist and really how nascent it is within the current, 3.0. And acknowledging that some of the pieces of the English language to generating code was some of the easy parts, and that some of the apparatus around it was still very immature. And I think we see that in, pitches every week of people observing these gaps or these things that just are obviously clunky, and where you can learn from the prior generations of have some sense of how it should evolve, and folks trying to race to fill in those gaps. The other point that I really liked from his talk was about this idea of an autonomy slider. Mm-hmm. And he makes a funny comment about like, let's be serious, he kind of is like, we shouldn't just like let it freely go. Like we know they are fallible. And so we should build accordingly. But I think something that we are seeing in founders as they understand a problem space is figuring out where is the right place to put that slider within their context.
Sure.
And a lot of the solutions are sort of anticipating where the technology will be able to get to, but sort of absorbing some of that and making it invisible to the customer today, and knowing that it'll be able to catch up and they'll slowly be able to move that slider. And I thought he did a really nice job of sort of capturing what is a really important element of how you build with this technology, but also one that we see, I think being an important vector of how founders are building within this space.
The human is not ready to fully give up control over that process or that outcome. Certainly in things where the outcomes are high stakes. I mean, think about AI in a healthcare context, or for Andrej Karpathy, AI and autopilot or autonomy in a self-driving context. You still need to design in patterns to eject out of those autonomous loops, so to speak, and allow a human to take over. And I think increasingly we see the best founders are sober about that. I think they're realistic about, hey, we can't just immediately out of the gate displace the humans in this loop. Let's be assistive. Let's reflect their current workflows and try to augment what they're doing. Let's certainly give them the dials and the controls to be able to intercept whatever is happening and verify it, audit it, and potentially change the outcome if they need to. That's the part of the thing that we're always evaluating at Accel, which is, do you really understand your customers? And understanding your customers, I think there's a nuance here of there's a psychology to that end user that can you appreciate that they're not ready to just fully hand over the keys?
Or when and where, right?
Yeah.
When do they want you to take the keys? When do they really not? Yeah, absolutely.
Yeah, absolutely.
It was kind of fun to hear him reflect on that pace of change, even himself. He's very much known to be a great thinker in this category. But when he starts the talk, he kind of says, I gave this talk, 6 months ago, but it feels time again, And so you kind of get that sense of even, some surprise in himself at how quickly it's evolved.
Our business at Accel is not just investing money, but ideally it's also returning money. And, we've been in a period of, I don't know how to describe it, austerity. I mean, we haven't, the exit environment has been somewhat closed for a variety of reasons. And in the last 6 months, it feels like the floodgates have kind of opened up again. And that's really exciting. And no more exciting a story for us than two companies that we led the seed and Series A in. First was Circle. That was a really cool moment to see that company go public and all that's happened around that ecosystem, even in the last couple of weeks with the Genius Act and sort of how we're starting to embrace stablecoins generally. And then, we're talking about AI and we're talking about, in particular that software 2.0 era where we were feeding systems data. And from the interpretation of that data, we were able to generate results. And so a key part of that equation is well-labeled data that you send to the systems. And Scale AI was, the dominant category creator in that space. And, that was such an awesome moment for our partner, Dan Levine, who we were going to drag onto this podcast at some point to tell us the founding story. But really cool to see those two companies have all of their hard work realized.
Yeah, absolutely. Maybe taking Circle first. That space has had such an evolution over the years. And I'm sure, sometimes we talk about how, sort of in hindsight, it can seem like the overnight success. But do you remember some of those mile markers along the way? Maybe when, crypto winters of yore and the conversations, and maybe there's some lessons of fortitude or of, conviction or, things to take away from that Circle journey. Because it was a long one and just an incredible outcome.
Jeremy, when he started Circle, actually, it was originally called Founding Circle. And, he was in an area of the world that faced a lot of skepticism. I mean, this was early days of crypto. Man, was Bitcoin even worth more than $1,000 at that point? I mean, it's at 115 now,
Right,
115,000 today. It's definitely a very emergent space. And a lot of his vision was around building a consumer mobile app that allowed anyone to be able to onboard into this ecosystem and participate in it. Jeremy's he's always been a very forward-thinking technologist. And I mean, the evolution of that company, he had to take any number of twists and turns. And that's one part, the rise and fall of crypto asset prices. We all remember the crypto winter and how painful that was. But along the way, he sort of evolved the story from being this consumer mobile app called Founding Circle to being more of an infrastructure provider. I think as he was exploring this category, I think he realized there was a real need for trust. USDC comes out and, it's a stable coin that's backed by US dollars. And so it's meant to be very one-to-one. It's if you trust US dollars, you should theoretically trust USDC. It's just been fun to see the kind of institutional embrace of stable coins and USDC in particular. And I think you give a lot of credit to Jeremy and the team for their prescience in not only designing what they designed, but doing it in this way that he felt like they could be trusted. And if you win the institutions, then, hopefully you're going to be able to win, the modern consumer.
That story also captures something that I feel like we've talked about a few times here, which is that we don't, expect that the original idea is going to be its ultimate, incarnation, but really that, you had somebody that you knew was an incredible leader and an incredible technologist. So you could trust that him operating in this space that was emergent, as it evolved, he would be responsive and reactive to that. And I think it's evidenced in what he's built, so that he was able to kind of understand what were the gaps and what would be the unlocks and transform that sort of consumer, insight into more of this infrastructure play, which is what the industry sort of, needed. So it's a great example of what I think we see in a lot of great founders.
It's fun comparing the founding stories of Circle and Scale in particular. It's particularly fun to juxtapose them now that they've both had their these great outcomes.
I mean, I feel like I have seared in my brain this image of Dan's basement and he and Alex walking through it and actually touring, the bedroom, the bathroom. They make some joke that like the bathroom had been redone since he was there. So even this dungeon that doesn't look particularly appealing was better than the shape it was in when Alex was living there. There's all this, the lore of companies started in garages, and I feel like the Scale origin story of Dan's basement is at that level of lore within the Excel halls. Yeah,
absolutely. As I remember it, correct me if I'm wrong, Scale as it exists today was not the first idea for this company. I mean, this was Alex, who, funny enough, was a 19-year-old when we first funded him. He was the youngest founder we'd ever backed. Oh, wow. And he was building an app that sold to bartenders, was it? I think it was almost like a pseudo ERP that the bartender could sort of point an app at his shelf of liquor and figure out what the stock was, what his inventory was. Yeah. And as part of that, you kind of needed to label, label these bottles, these images of these bottles, and know exactly where the Grey Goose was in the bottle at that time. And that's sort of what led him to this realization that, oh, wow, like we're at the end of software 2.0, at the beginning of software 3.0. Yeah. But in that transition, we're just going to need a ton of data, and it's got to be well labeled, and it's got to be labeled by people who actually know what they're doing. Right. And so let's go figure all of that out, because if that works, we're going to be able to enable any number of bar, restaurant, ERP, inventory management tools out there, and many, many more applications. Right. Both Jeremy and Alex, I think, embodied a skill set that we don't often talk about, at least on the early stage, which is government relations. Alex really made this concept of the data foundry and AI generally part of the strategic mandate for the United States and for the defense ecosystem. And what AI was going to mean for our national interests. And there are any number of talks online that, folks can go see of Alex testifying in front of Congress and meeting with senators and generals and really helping to advance the cause of what AI was going to mean for the prosperity and the security of the United States.
Right.
I think similarly, Jeremy and the Circle team, how was the U.S. going to be an innovator as it related to the crypto ecosystem, as opposed to a laggard? And how could stable coins and the idea of a digital U.S. dollar really solve some of the fragility of our financial ecosystem on which our economy is built, on which arguably the security of our nation is built?
Right.
And so convincing people to be willing to reinvent things as low level in the stack as like the piping from which through which the financial ecosystem is rendered, and how that's now manifested in sort of a congressional embrace of stable coins and its broad use. I think both Alex and Jeremy were maybe the thing that they did share in common was an appreciation for how a regulatory regime can help to legitimize you, and how that can in turn be an accelerant as you're thinking about enterprise adoption or customer adoption.
The prescience of what Alex built, I feel like, has really just hit its stride in this moment. Like this is the moment, we talked about times when it was just the tip of the spear. It is not that any longer, right? This is a mainstream core need of every company that's building, new AI applications. And so excited for Alex and his role at Meta, but also incredibly excited for what lies ahead for Scale and what they've built, which is just such critical infrastructure.
Just chatting with other Scalians, yes, this was an out of the world moment for them and the company, but there's so much excitement for what's to come. It's like, wait, hold on, we're not done yet, by the way. Like, yes, this is a cool mile marker and a cool moment for the business. But there's still so much to do, and they are continuing to build on their lead and their advantage in the category. And so I couldn't stress enough more. The Scale story hasn't finished. It's in some ways only just beginning. And man, I can't wait to see what happens with the company going forward. That's a great segue to, I think, something that we're talking about a lot right now as a partnership, which is we are intersecting founders younger than ever. They are oftentimes dropping out of great CS programs at great universities, but the file or the dossier on who they are, what they've done is relatively thin. The signals that we used to look at that would confer legitimacy or confer some substance to an entrepreneur, a lot of those signals don't exist anymore, purely because they're starting well in advance of when they could accrue those signals. And in some ways they eschew, that the classic resume of, hey, I went to Stanford or Berkeley and I graduated with a CS degree, I got a master's, and I went to work at Facebook and Google, and now I'm starting a company. I think, the social currency for the next generation is something we've talked about before. Again, less what you have done in these institutions and more what you have contributed, what you've created. We are increasingly trying to develop not a fact pattern, but at least some instinct around what makes a really young technical founder like that really exceptional. And I haven't figured it out, but I'm curious. I'm curious if you're developing any intuition around it.
When I first heard Alex speak and give an extended talk about his childhood, his upbringing, just how he thinks, it was clear he was exceptional. So we're talking to founders all the time, questions across a variety of topics. One of the recurring ones is about exits. So how should founders be thinking about the exit environment?
I think, in fairness, a lot of the best founders aren't thinking about exits. They're thinking about just solving the core problems for their customers and prosecuting the market that's right in front of them. That being said, I think there are, especially for some of our mid to late stage companies, I think there are ways to manufacture serendipity that, whether you want to take advantage of it or not, can create the opportunity for M&A, should we choose to go that route. So, building the right partnerships with the folks in your ecosystem, having real tight integrations. There's a business development and a sales partnership where you kind of put one another's logo on your website, and there's a bit of a loose connection. Mm-hmm. There's the more substantive partnership where you actually have an integration and you're sending data back and forth, and you are using that to deliver a more holistic solution to your end customer. Mm-hmm. Those are the best types of partnerships. And if you're a large company and you're thinking about making an acquisition, one of the first things you might do is just look at my API traffic. Who am I sending data to? Who am I reading from? Mm-hmm. What customers in my roster have I partnered with this startup on? Mm-hmm. And could I imagine, partnering with this startup across many, many more of my customers?
Right.
It's worth thinking about as a startup, who are the logical partners in my market? Mm-hmm. And how can I start to develop some of those relationships, and how do we actually go win deals together? Because that's the motivating factor behind potential M&A.
I think if you've used that as your North Star for who you're spending time with, it also makes it more likely that if you do end up in the M&A path, that it is actually a vehicle for still extending your vision and bringing it to life, as opposed to something that's more orthogonal. Yeah. But if you've been building and delivering against this vision somewhat in collaboration, because that naturally was the right thing to do for your customers.
Yeah, exactly.
It's more likely you can continue to fulfill that vision,
totally agree.
As a combined entity.
The one notion of M&A that's maybe worth disabusing is that when you're ready to sell the company, let's go meet 10 potential acquirers and tell them our story for the first time. Mm-hmm. In my career, I've never seen a successful exit happen with a company that met one of our portfolio companies for the first time. Mm-hmm. It's not just a partnership. Sometimes it's an interview. It's an interview that spans over years. And so, you take Scale's partial exit or now strategic relationship with Meta, and that was the result of years of relationship building between Alex and Mark. Mm-hmm. And I think similarly, all the biggest, most consequential exits that we are going to see are going to happen at this sort of intersection of co-development and co-selling and relationship building. So it doesn't happen after having met someone for the first time.
Right. Which I think relates to another question that we received, which was about, do founders stay on after an acquisition? And I think what you're describing is really sort of an interview process for a senior leader and somebody who's hopefully going to carry the torch forward and create all this economic value within the acquirer.
Sophisticated acquirers sniff out when the team is going to head for the exits the second they hit their vest or the second the money hits the bank account. And it's just really important to, as a founder, hopefully it's earnest, but communicate your ambition. Imagine what it could be like to integrate our two technologies more deeply and go to market together and sell more deeply, and sharing your vision for how you want your technology to be in the hands of everyone in the world that it's relevant for, and how the acquirer can potentially help you get there faster because they have all this existing distribution. I mean, you have to communicate that ambition, and you have to convey an excitement to wanna, to your point, run something important and meaningful and create economic value inside the acquirer. I mean, Sarah, one thing that often comes up in this discussion with our later stage companies is how to think about those two paths. Are we going public? Are we going to be a long-term independent business? Or should we think about acquisition or a strategic outcome with someone else in our space? And, how have you been thinking about that with the founders that we're working with?
Well, one thing to note is once you've made it to this point, if you're considering, you've got your sights on IPO, that oftentimes is the ambition, but you spend a lot of time building, finding product market fit, hitting these milestones along the way. So at the point where you're sort of evaluating this in some sort of fork in the road, you hopefully have established a meaty business that's sizable. And then I think there's a lot of considerations, but I think there are certainly expectations of a publicly traded company that you have to evaluate the business that you've built that may be more or less compatible with sort of a retail investors writ large, right? And some of that is just about, the predictability, different metrics, your ability to forecast. Like, you can create something of great value that may not precisely hit the formula that does as well in an IPO market. So there's some consideration of just holding up your business to a mirror of how it will perform in that type of environment. And then I think, there's another evaluation around sort of long-term independent success, and that comes back to, well, what is the 10-year, 20-year goal for this business, and how will I best achieve that? Mm-hmm. And that may be fulfilled through a public offering, and it may actually be fulfilled through collaboration with somebody who has even greater distribution or who has incredibly complementary, assets that they've built. And so being able to sort of take stock of where you've come to and where you're trying to get to, and then asking the question of what is going to be the right way to resource this organization for that road ahead.
Yeah, no, I think that's really well said. It's because there is a third path there, which is just stay private longer.
Right.
And we're seeing a lot of companies choose that path.
Right.
They would say, hey, based on what we need to do, the innovation that we have in front of us, the CapEx that we need to spend, we would rather grow through those realities in the private markets as opposed to in the bright lights of the public markets. And that totally makes sense for some businesses.
Right.
And you've definitely seen case studies with Stripe and Databricks in particular that would say, hey, we want to be public someday. Mm-hmm. We know that's an important outcome, but at least right now, the right thing for the business is to continue to grow in a private way. Mm-hmm. Jim and Arthur would always say, the IPO isn't a liquidity event; it's a financing event. Mm-hmm, and mm-hmm. implied in that is the idea that this is a moment to push the company forward to where it's meant to go, mm-hmm. and that could mean having public currency so that you can make acquisitions. Mm-hmm. Easier to make acquisitions when you have public stock versus mm-hmm. hard to value private stock. Certainly that's extra cash, the proceeds from the public offering. Mm-hmm. Some of that is probably liquidity. It's nice to have the work of the employees rewarded and recognized. And as a result, you can drive retention up because suddenly the equity that you're earning into feels a lot more tangible. I see it often as a vehicle to quite frankly grab more market share. Mm-hmm. It's you'd be amazed at the number of Fortune 5000s that just want to buy technology or products from a public company. They just feel like they're more trustworthy and there's a going concern there, and they can look at the financials of the business and really trust that this company is going to be around for them for a long time. And so being public it's a weapon, it's a sales weapon to go out and grab as many customers as possible. I love to view the IPO through the lens of what can we now do that we couldn't do before. And if there's a really compelling reason for that, we should do it. Mm-hmm. But oftentimes there isn't. And we can just keep ideally growing as a private business.
Right. And to your point, there can be other mechanisms for taking on more capital for investment or motivating and incentivizing employees who have been there. There are other ways to satisfy potentially some of those, benefits. And so being just thoughtful about what you employ.
Yeah. Well, that is it for this week's of VBSR. Again, we got so lucky this week because we've had a lot to talk about. We had a lot of really cool moments at Accel. And again, hat tip out to Dan Levine, hat tip to the team at Accel that was working on our Circle investment. Yes. Really cool moments for both of those companies and those teams. But, for the rest of us and them too, we're just back to work.
Yeah. The next Alex, the next Jeremy. Yeah. We're here, we're taking meetings.
Yeah, for sure.
We're on the lookout. Inbox open.
All right, till next time, Sarah.
Take care.